It's Brian Preston, the money guy.
Okay, let's talk about the 30-year-olds. This is your decade of your 30s. For me, when I think about this, I think of the messy middle.
When I think about this, I just think about every single day because I am living this like every single moment. For the ease and simplicity that was the 20s, boy, is it met hard with the complexity and the messiness of the 30s.
Well, Bo, you have a way of saying this, and I thought we wrote this down because I liked it. And I don't know if it's yours, but it's still incredible.
If it's really good, I'll take credit for it.
Days are long and the years are short.
I did not come up with it, but boy, is that true.
I mean, because it's true. I mean, if you're in the messy middle, you know you wake up 5:30 in the morning, and then you're laying your head down at 9. Or that's not even at bed.
You're laying your kid's head down at 9.
Well,
and then
you get to tap out. You finally get to take a few hours for yourself because the hours just disappear. We've joked about once you have you're married, once you have kiddos, you look at your spouse and you go, "What did we do when we were in our 20s?" Because
my wife and I have that conversation weekly right now.
The time is just moved so quick. Also, this is because you have so many commitments. You like I said, you likely have a significant other. You might be, procreating and growing, having more children and having children.
Okay.
So work-life balance becomes more important. And then, this is also where I think you have to pay attention to lifestyle creep.
That's
and
right.
Trying to keep up with the Joneses. That is definitely, these are legitimate issues that are definitely a concern.
Yeah, and I think even when we think about lifestyle creep, that's sort of a perfect segue into thinking about in your 30s, how should you think about cash flow? Well, realistically, this is probably the first time in your life that you begin to have some discretionary cash flow for the first time. It's not just about survival anymore. You're recognizing, oh, I have a little bit extra. Well, one of the things you have to keep in mind is that your 30-year-old self is very different than your 20-year-old self. So just because that 20-year-old that you were got so excited about maxing out the Roth IRA at 20, now that you're in your 30s, you actually have to improve upon that. You can't just rest on your laurels of what you did in your 20s. You actually have to get better. Don't let the discretionary cash flow just allow your lifestyle to creep and your lifestyle to expand.
Well, you've talked about it, is that, we've shown the stat that if you want to be a multimillionaire in your 20s, or if a 20-year-old, all you have to save is a little less than $200 a month.
That's right.
But the problem is you fast forward to when you're in your 30s, you probably need to be saving more than a little under $200 a month because you're making more money. Because remember, the goal is 20 to 25% is going towards the long term. So watch out for that. You don't want to also let lifestyle creep, because this is the part we talked about. We know that the average house purchase occurs when you're 33 years of age.
That's right.
When you're in your 20s, I told you I don't pick on the latte factor because I typically want people to focus on the big decisions like the car purchases, the houses, and those type of things that are whittling away. Well, the little stuff's not eating you up anymore.
Right.
And now it really is keeping up with the Joneses instead of little oopsies. Man, I got a coffee today. That's hurting things. Now you're like, oh my goodness, how did I get strapped with this $800 a month car payment? Did I go buy a house that's way too much for where I'm living that I can't save for the future? This is the stuff that will get you in trouble.
Yeah, I remember in my 20s, ouches were like hundreds of dollars. In my 30s, it seems like ouches are thousands of dollars. Another thing that you'll probably recognize in your 30s from a cash flow perspective is you're probably beginning to understand, am I just working a job? Am I just showing up and clocking in and clocking out, waiting for my thing? Or am I actually into the career? Am I settled into what I'm going to be doing for the long term?
And I think that's an important thing. I mean, you want to be planning ahead. We always want to have kind of a vision for what the next 5 years looks like, what the next 10 years looks like. So don't just take it for granted. If you are just putting in the time, you wake up and you just feel like you're on Groundhog Day over and over. Great movie by Bill Murray, by the way. But it is, if you're on that treadmill of life and you're not happy because it's not a career, you don't see a career path, pay attention. This might be the time to figure that all out. This is because, look, there's great performing investments out there, but nothing is going to do better for you than how the size of your shovel. If you can make your shovel bigger, meaning the amount of income you can create for yourself, pay attention to that, because that's going to help out with a lot of the other financial things that we discussed.
And I think we even said one of the 7 traits of millionaires is they chose the right occupation. Well, if you're in your 30s, you should start recognizing, did I choose the right occupation or did I not? And if you want to be a millionaire, which is what we're coaching you through, make sure you make that decision well.
Let's talk about risk management.
Sure.
When you're talking about 30-year-olds, I've talked about you're starting to get the trappings of life, meaning kiddos, spouses. There's a likelihood that these people are starting to count on you for your income.
That's right.
So if you left early, you always talk about a bus hitting you. I like to think that death is going to come much softer and quiet and nicer to me. But it is one of those things I think you need to plan ahead, and that's where term life insurance, disability insurance, those things definitely should be on your radar. And then, Bo, we talked about emergency funds.
Yeah, an emergency fund. In your 20s, perhaps you can get by with just having your deductibles covered, or maybe operating lean, because maybe you can go ask mom or dad for money, or maybe whatever there is. Once you start having other human beings depending on you, once you start having significant others and children and that sort of thing, an emergency fund is a non-negotiable. It's something that you have to have in place, because it is going to be that thing that protects you from that, HVAC went out. My kid broke their arm. The car has to go into the shop. Your emergency fund is the thing that makes sure your financial life does not come to a screeching halt.
And just because all your friends are swimming naked out there in their lifestyle and really not keeping cash reserves and building up assets doesn't mean you should, because there will be, believe me, every decade there's going to be some type of crisis. There's going to be something that pulls on your wallet unexpectedly. You need to have margin to make sure you navigate that well. And that leads to, because let's talk about this. I had a client, now this has been a while back. Their child, who by the way was in kindergarten at the time, who now this is how long I've been doing this, graduated from college, married. So I've been managing money for a long time.
Really
So this is a kindergarten when this thing, threw rocks at a bus.
Oh, because that's a great idea.
Went through the window of the bus, or the down window, hit a girl. She had to get stitches. It turned into some litigation. Guess what covered it all? Umbrella insurance. So guys, good time to have insurance that sits on top of your auto policy, your homeowner policy. It's pretty cheap. Look into umbrella insurance. You can get $1 million worth of coverage for just a few $100.
Yeah, if you have assets that you've begun building, or if you have current healthy income or future healthy income, umbrella policies are just too cheap not to have. You want to have roughly the equivalent of your net worth, rounded probably to the nearest million. So for someone in the 30s starting out, $1 million of umbrella coverage is a great solution.
Let's talk about investing.
Okay.
Making those army of dollar bills work for you. This, I'm kind of counting on you. Look, in your 20s, you're broke. I get it. I give you some grace. By the time you get in your 30s, I really, really want you saving 20 to 25% of your gross income. That's a non-negotiable at this point.
And remember, in your 20s, your army of dollar bills was so stinking powerful, like 88 times over, 66 times over. In your 30s, you start to lose a little bit of that juice. Now, it's still powerful and it's still going to work for you, but you better be saving that 20 to 25%, because $95 a month in your 30s isn't going to get the job done.
Well, think about this. When you're 20 years of age, $1 turns into $88 by the time you're 65. Has the potential to do that. Just 10 years later, 30, it's now only has the opportunity to turn into $23.
That's a big difference.
That's a huge difference. Still incredible. I mean, look, as a 40, soon to be 47-year-old, I'm looking at 23 as a great multiplier, but you just need to be paying attention to that. Here's another thing. Kiddos. You're going to start having kids. Focus on your retirement savings. That 20-25% is for you and your spouse and their retirement. You only get to look at saving for the kids' college and other things after you take care of your stuff. So you do need to be saving 20-25% for yourself, and then you can think about the kiddos and their college savings, 529s, and other things after that. I also think here's something to pay attention to. Just be on the lookout for it. A lot of you, some of you might not graduate to this, but if you are a hyper accumulator, as soon as you cross over about $500,000, $500,000 of investments, you probably are reaching the stage of, have I graduated from index target retirement funds? If you're under $500,000, I still think they're great for you. It's a simple thing. Bo talked about it earlier. Just have two decisions. How much can I save? Hopefully it's greater than 20-25%. And what year do I need the assets? That's all you have to do with an index target retirement fund. Once you get over $500,000, you might want to get a little more sophisticated, because you'll care about tax location, you'll care about loss harvesting, you'll care about gifting appreciated assets for charity. There's a lot of powerful things you can do.
There's just some different weight to the decisions you make once you get to that asset level can have. And just anecdotally, we've kind of seen this, Brian, with our clients. It usually is in sort of that mid 30s to late 30s when that starts to happen. But even though the gravity of your decisions is getting bigger and the size of your portfolio is getting bigger, your savings rate, I would argue, in your 30s is still exponentially more important than your rate of return. So rather than focusing on trying to finagle your investments to squeeze every bit of return out of there, you ought to look at your cash flow and figure out, how can I save just a little bit extra in your 30s? Because again, the work that you do in your 30s, your 40 and 50-year-old self will thank you for.
No doubt. And that leads to tax planning. Here's something. Do you do Roth contributions into your employer retirement plan? Do you do traditional pre-tax, meaning you get a deduction on it now?
Sure.
These are all decisions that you're trying to make when you're in this stage. Here's what we think about it. Once you combine your federal marginal rate, your state income tax rate, and it's somewhere in that 30 to 35% range, that's area that's kind of gray zone that it might make sense to more take the deduction now than it is to do the Roth where you get the tax-free growth. So that's why I'm saying if you're under 30 and you're young especially, consider the Roth. But as soon as you get in that 30, 35, you've even said, Bo, 25 to 30 might be in the gray zone on some people.
You may want to split it. It depends on your specific age and account structure and that sort of thing. But certainly if you're in lower bracket, we love tax-free. Higher bracket, we love getting the tax benefit. And that's kind of how we think that 30% is that cutoff.
And the reason this is also playing out is that, look, your income while you're working is going up, so your tax rates will be going up. Your goal or hope is that if you do this correct, and we'll talk about the bucket strategy later, is that by the time you reach retirement, you actually have the ability to manipulate what your tax rate is in retirement because you'll have options. And that means that potentially your tax rate will crater down into the lower rates. So that's when you can do some Roth conversions and other things at that point.
The other thing that happens in your 30s is that, again, messy middle, you're pulled in 1,000 different directions with family commitments and work commitments and community commitments. You may just find that when it comes to like doing taxes and that sort of thing, you just don't have the time. I think a lot of folks recognize in their 30s, man, instead of me doing my own taxes, trying to figure it out, trying to piece it all together, this might be the time from a tax standpoint where it makes sense to reach out and get professional help. There's nothing wrong with doing that. Again, you have to figure out where you want to focus your time and effort. And I'm of the opinion a tax professional might make a lot of sense if you got 1,000 things going on.
What's interesting, I did taxes professionally for over 16 years. Sold my tax practice. I mean, it's been I guess we're getting close to a decade now.
Almost a decade.
I still am paying that because that part of the deal when they bought my tax firm was I had to continue to use their professional services so we'd have a smooth transition for my tax clients. I'm still using a paid preparer.
You still don't even do your own taxes,
and I'm not on commitment anymore because it's kind of fun. I mean, I know fun's probably a weird word for people to hear, but from a financial mutant standpoint, I like being the quarterback of the situation. I write up all my notes, all the things I'm considering. I fill out the tax organizer completely, but man, is it cool to see that thing come back already done, and now I just have to review it and then actually going through and scrambling around to figure out which box to put where.
I would argue that reviewing a tax return is way more fun than preparing a tax return.
No doubt. So it's also a better use of my time. I mean, me reviewing my tax return after a professional's done it, much better than me poking around for hours on end to get the tax return done. So let's move on to estate planning. I told you, you're likely at this stage, you get the trappings of life. You have a spouse, significant other, that leads to kiddos. You're going to need wills if you have kids because you want to make sure that the state is not determining who takes over the kids. If you think a conversation's hard while you're living with your spouse about the family, because we all have family, and I know those are some weird conversations. Think about how hard that conversation is going to be when you're not even here.
That's right.
And then the state's trying to figure out where your kids go. Make sure you have wills. That's a no-brainer.
And then also, as your life circumstances do change, you get married and you have kids, make sure you're keeping the beneficiary designations on your accounts updated. When you get married, it probably makes sense to switch it from your brother or sister to your spouse. When you have kids, probably makes sense to add contingent beneficiaries or start thinking through that. You just want to make sure that as your life changes in your 30s, your financial plan adjusts to reflect those changes.
And let me give you a head start so you lower your legal bill when you get these wills done. Go ahead and talk to your spouse. This is going to be the harder part of the conversation. Who do you want to be the guardians of your kids if you both died at the same time? Who do you want to be the executors in case you're not here? Because it's easy to say you want your spouse, but what happens beyond your spouse? Trustees, if you're creating any trust in there, you're going to need to name those as well. These are the hard conversations you ought to have, as well as what type of health care you would like, and just in case there was a bad accident
Now,
or something.
This seems obvious, but I'm going to say it because it makes sense. Don't let this be a surprise to the people that you've selected to fill these roles. Meaning, if you really want your brother and sister-in-law to be the one to take care of your kids if something were to happen to you guys, make sure you have that conversation with them. If you really want your uncle to be the executor of your estate and to carry out make sure you have that conversation so they know to be expecting that if something were to happen.
It's a great Hollywood plot, not a good life plan when you just let the kids, you die tragically and your kiddos go to somebody. Because there's been so many movies where the ditzy single relative, inherits the kids and then, has this transformation over life. Great movie, horrible life. So don't do that. That's not what you want to do. Let's talk about some hard numbers.
So here's how powerful your dollars can be in your 30s. If you're a 30-year-old, you only need to save about $270 a month to get to $1 million by the time you turn 65. For a 35-year-old, the number is just over $450.
Here's the thing. I know you're going to keep going, but I think people look at those numbers and go, that's doable, so doable that I bet your car payment for most people is higher than those numbers. That's a no-no, guys. Your savings and investing needs to be bigger than your monthly car payment.
Absolutely.
So pay attention to these numbers. This is important.
This is where I get excited, and this is where I think my friends get excited, though. If you're a 30-year-old and you've been doing the really hard work in your 20s, and you've saved $43,000 without saving another dollar, if you can earn, on average, 9% from now until the time you get to 65, you're already on pace to be a millionaire.
Yeah.
If you are 35 years old and you've saved about $78,000, $79,000, you've already done the hard work of becoming a millionaire. But you've already said this, Brian, $1 million in the future may not be worth what $1 million is today. So what if you want to be a financial mutant and you want to double that? Well, for a 30-year-old, now you're just barely doing more than maxing out your Roth IRA. You're saving $540 a month to get to $2 million. Or for a 35-year-old, you're saving just over $900 a month to get to $2 million by the time you turn 65.
Here's something I think, because you've got the $2 million. You brought up the financial mutant for a 30 and 35-year-old. It's $86,000, a little under $87,000 for the 30-year-old. 35-year-old, it's $157,000. I want to look squarely at my doctors, my attorneys, all the professionals who, unfortunately, were in school a lot longer than the rest of us.
Sure.
You're probably getting out of school close to 30 years of age, and you're excited. You're like, hot diggity dog, I'm headed towards a higher paying job. But a lot of you guys, you also come out with 6 figures worth of student loan debt.
And no assets built up.
So I want you to think about this. If we're on the financial mutant side of things, you come out of college because you're a doctor or you're some other type of professional like an attorney. You come out of school with $100,000 of student loan debt, and then your peers who have been doing it right are getting right at $100,000 in assets with $87,000 to be a millionaire. You are down by several $100,000. Let that sober you up. Do not go buy yourself that European luxury car just because you got through with your residency. It doesn't, you're behind. Get scared, get it motivated. You can reward yourself later. I'll talk about that when we get in the 40s, but this is the time you've got to play catch up.
Brian, you've told me this before. The 30s is the messy middle, and it's hard. But if you can survive it, because a lot of the messy middle, frankly, is just surviving, especially having little kids, you will be happy about the work that you put in. And that's not just on the financial side, that's on the life side. So if in your 30s you can take a second and pause and take a deep breath and not have a nervous breakdown, you're going to set yourself up for some pretty happy 40s, 50s, and 60s.
I look at the 40s and I realize I'm coming to a close on this decade. Man, how in the world does that happen? But it does happen, and I consider this really as a fork in the road moment. And what I mean by that is this is when you start celebrating that the plan is coming together, you've made it happen, or you're jumping on that bitter train